His paycheck jumped by about 12% overnight. Then, tax season hit. The IRS did not care about his excitement. This is the kind of mistake that feels impossible. You worked the extra shifts. You missed birthdays. You earned that money. By the end of this video, you will know the exact rule. You will know who qualifies. You will know how to claim it cleanly. There is one detail later that flips the whole outcome. It sits on your W-2. Most people never look at it. This is about your no tax on overtime rule for 2026 and how one deduction decides what you keep. Welcome to Cash Flow Decoded. Now, real quick, this is educational content, not financial advice. Consult a professional before making financial decisions. But what I can do is show you exactly what is happening. Then you decide what to do next. But before I show you the solution, you need to see how deep this goes. Meet Sarah. She is 36. She is a hospital nurse in Pennsylvania. She picked up overtime because life got expensive. Sarah saw bigger checks and felt relief. Then her refund came back smaller. She thought payroll messed up. What changed is a new federal deduction. People call it no tax on overtime. That name is tempting. That name is also how people get burned. This rule comes from the One Big Beautiful Bill Act. It creates a federal income tax deduction. It covers qualified overtime compensation. Here is the key word: qualified. Not all overtime is qualified. That one word decides if you keep money. The deduction is only for the premium portion. Think time and a half. Only the extra half can count. If you earn $20 an hour normally, overtime might be $30 an hour. Only $10 an hour is the premium portion. Most workers still pay full federal income tax on that premium. They never claim the deduction. Not because they hate money, because the reporting is new. The deduction is available for tax years 2025 through 2028. That includes the return you file for 2026 income. If you miss it for 1 year, the loss can stack fast. That is how someone loses over $18,000 across multiple seasons. But it gets worse. Some people claim the wrong kind of overtime. That can get the deduction denied. Then penalties can follow. But here is what nobody tells you about your no tax on overtime. This deduction has caps. It is not unlimited. The maximum is about $13,000 for single filers. For married filing jointly, the cap is about $25,000. That sounds huge. It can be huge in the right bracket. If you are in a higher tax bracket, a deduction can save serious money. Some people can save up to about 35% of that amount. That is why the cap matters. Around $13,000 times around 35% is about $4,500. That is 1 year of savings for one worker. Now imagine 2 spouses both working overtime. Joint filers can chase the larger cap. That is when the savings can feel like a bonus paycheck. But the IRS does not hand this out for free. There is an income phase-out. That is where people get blindsided. The phase-out starts when modified adjusted gross income is over about $150,000. For joint filers, it starts around $300,000. Then it fades away. It fully phases out around $275,000. For joint filers, it ends over $550,000. Here's the part that makes this personal. Some households float near that line. Overtime pushes them over it. They celebrate the extra pay. Then the deduction shrinks. That can make your withholding feel wrong. That can make your refund vanish. That can make you blame the wrong enemy. Now back to Sarah. She is not rich. She is not near those phase-out numbers. So she assumes she is safe. But the real trap for Sarah is different. Her overtime includes different types. Some are FLSA overtime. Some are not. Qualified overtime is only FLSA required premium pay. That is hours over 40 in a week, paid at time and a half. State rules can be stricter. Contracts can be different. Voluntary premium pay can be generous. None of that automatically qualifies. If your employer pays daily overtime, that might be state required. That might not count for this deduction. If your union contract pays double time on holidays, that might not count. If your manager offers incentive overtime, that might not count. And if you claim those as qualified, you can lose the deduction. Worse, you can raise red flags. So you need one proof point. You need the overtime amount reported correctly, and you need it separated from other pay. Now meet Marcus. He is 42. He runs maintenance for a school district in Arizona. He lives on overtime. Marcus heard the phrase, "no tax on overtime." He thought it meant payroll stopped taxing overtime. His checks looked bigger for a stretch. Then he changed his W-4. He lowered withholding even more. He thought he was being smart. Then he got his W-2. The overtime was not separated. It was blended into wages. That is where the 18,000 story starts. Drop a comment if this has happened to you, or if you have no idea what your W-2 shows. And that is when everything changed. Marcus filed his return and claimed the deduction anyway. He used his own math. He guessed the premium portion. The IRS disallowed it. His software could not support it. He owed tax back. He also owed interest. He had to fix prior choices too. His W-4 change made the bill worse. That is how the pain snowballed. If this makes sense, hit that like button. It helps more than you know. Watch this next part carefully. This is where it turns around. Here is the solution. You need to confirm 3 gates. Then you claim the deduction the clean way. Gate 1 is your worker status. This is for non-exempt hourly workers under FLSA. Salaried exempt employees usually do not qualify. Gate 2 is your filing status. If you are married filing separately, you are out. That surprises people. It is in the eligibility rules. Gate 3 is your identity requirement. You need a valid SSN by the filing due date. If you do not, you can be disqualified. Now, the reporting rule. For the 2026 tax year, employers must report qualified overtime. It goes in box 12 of the W-2. The code is TT if you do not see that separate entry. You cannot claim what is not reported. The deduction is only for separately reported amounts. That is why Marcus got crushed. He assumed his pay stub was enough. The IRS wants the W-2 code. So what do you do first? You ask payroll one direct question. Are you tracking FLSA premium pay separately for W-2 reporting? You also ask a second question. Are you coding qualified overtime as TT in box 12? If they hesitate, you push. If payroll says it is blended, you ask for a correction process. You ask what they need from your manager. You keep receipts. Next, you confirm the overtime type. You need hours over 40 in a work week. You need the premium portion required by FLSA. If your overtime is daily overtime, you treat it as suspect. If it is contract overtime, you treat it as suspect. If you are unsure, you ask for a breakdown. You want regular rate. You want overtime rate. You want premium portion. Now the math example. Regular rate is 20 an hour. Overtime rate is 30 an hour. The premium portion is 10 an hour. If you worked 100 overtime hours, your qualified premium is about $1,000. That is what could be deducted. If you worked heavy overtime all year, you might reach the cap. That cap is about $13,000 for single filers. If you hit the cap and you are in a higher bracket, the tax savings can be about $4,500. That is not small. Now the tax form move. This deduction is above the line. That means it reduces your taxable income directly. You claim it on your return for that year. And yes, you should adjust withholding. If you qualify, your tax bill may be lower. Updating your W-4 can stop over withholding. But do not guess like Marcus did. You wait until you have clarity. You confirm the W-2 reporting plan first. But what happened next changed everything. Sarah followed these steps before filing. She checked her W-2 for box 12. She found the TT code. She compared that number to her pay stubs. The amounts matched the premium portion. She did not try to deduct the whole overtime rate. She also checked her income for the phase-out. She was under the start line, so she expected the deduction to work. Now here is what this means for your money. If you qualify and you claim it correctly, you can keep more of what overtime was meant to do. It can cover debt. It can cover savings. If you miss it, you may overpay federal income tax. That can feel like you worked extra for nothing. If you claim the wrong overtime, you can trigger a denial. The biggest mistake is claiming non-FLSA overtime. Another mistake is missing the valid SSN requirement. Another mistake is being married filing separately. People learn that too late. So here is your checklist. Confirm you are non-exempt under FLSA. Confirm your overtime is hours over 40 weekly. Confirm your employer separates the premium portion. Confirm your W-2 shows. Box 12 code TT. Then claim the no tax on overtime deduction. Now we return to Sarah. She filed with the correct qualified amount. She did not inflate it. She did not guess. Her taxable income dropped by several $1,000s. Her federal tax bill dropped with it. Her refund came back healthier. For Sarah, the savings was around $2,000. That covered car repairs and a credit card chunk. It also reduced stress at home. And she changed one more move. She updated her W-4 carefully. She stopped giving the government an interest-free loan. That is the point of no tax on overtime. It is not magic. It is a deduction with strict rules. Follow them and you keep more. So let me break down exactly what you need to do. Remember the core. Only the premium portion counts. Remember the reporting. No TT code means no clean claim. Remember the limits. About $13,000 single. About $25,000 joint. Remember the phase-out range. So remember, your no tax on overtime is not just a form. It is your financial future. Check your no tax on overtime before Friday. Send this to someone who needs it before they lose another dollar. Drop a comment with the money topic you want exposed next. Hit like if this opened your eyes. Subscribe to Cashflow Decoded for more. Next week, another financial trap most Americans fall into.